Hi, so we're 2 days after the RBA March decision, and we've had our second rate rise in 2 months. Cash rate is now 4.1%. If you've got a 600 grand mortgage, your repayments are increasing over those 2 months by $200 a month. So $100 for each rate rise if you've got a 600 grand mortgage. Why? Mixture of domestic inflation, which has been a story for a while, and that's why they went in February. And now obviously we've got the war, and who the hell knows how long this is going to go on for, what impact it's going to have. Even if it finished tomorrow, there's probably going to be a residual impact for some months. So we're living in an uncertain world, and the chairman of the Fed over in the US overnight basically said, we've got no idea what happens next. So I'm kind of feeling okay about the fact that I've got no idea what's happening, because if he doesn't know, then there's no chance that you and I will know. So therefore, all we can do is evaluate our budgets and our cash flow and be on top of our numbers. Not the numbers that we thought we had 2 or 3 months ago, but the numbers as they stand now. And then the other key aspect is to think about, should I fix my interest rate now? So why do people fix? They fix because they want certainty. They want peace of mind. They're feeling anxious about their cash flow. They may not have a savings buffer to protect them if there's a couple more interest rate rises, and it helps you sleep at night. The downside of fixing is that you lose flexibility. So there's only so much you can overpay each year, and some of the banks don't allow you to take those overpayments back out. You do not fix because you think you're going to beat the bank. I promise you the bank will win, right? So it may well be, if you fix for 1, 2, 3 years, whatever, you end up paying more than had you stayed variable. But at least you've had that comfort that you knew exactly how much you were going to have to pay, and you could budget your household accordingly. My view is that in terms of fixing, it really is situation dependent. There's no single answer for everybody. During GFC and COVID, it was a bit of a no-brainer because the fixed rates were so low. It really isn't so clear cut now. Yes, you might be expecting 1 or 2 more rate rises, but what's going to happen next year, right? What happens if they start cutting rates and you end up back where you started? Would it have been worth fixing? So focus on the need for certainty and not on the specific interest rate that exists today or might exist tomorrow, because you've just got no control over it. Obviously, reach out if you have any queries about that whatsoever. We've had a bunch of conversations with clients this week, and we're all available. Otherwise, try and enjoy the rest of March, and maybe just try and avoid reading the headlines too often at the moment. Ignorance can sometimes be bliss.